Okay, so we can actually break down trends into three types. So we basically have the short, the medium, and the long-term trends and trend lines. So the short-term trends are basically found on smaller time frames, so from the 1 minute up to 30 minutes. Then the medium-term trends, we basically find it from the 1 hour to the 4 hour time frames. And then lastly, the long-term trends, which are the most powerful, are actually found on the 4 hour time frame upwards to the monthly time frame. So those are really powerful trends, but starting from the medium is basically something that we would recommend you to trade, because that is very powerful signals where they actually start forming. Because I mean, the 1 minute, as we say, there's a lot of noise, a lot of false signals, so you shouldn't be even looking at that. Based on the above, we can classify trend lines into three types as well. So the short-term trend lines, as we said, 1 minute to up to 30 minutes. The medium, 1 hour to 4 hours. The long-term trends, H4 to the monthly chart. So that's where we get our long-term trend lines, where you can swing your trades and hold your trades for for a long time. That is on our 4 hour to the monthly chart. So our long-term trend lines have more significance over medium-term trend lines, which have more significance over the short-term trend lines. So as we say, the long-term trend lines are more powerful than the medium, and the medium are more powerful than the short term. So what this means is very simple. For example, a short trend is down, but the medium trend is up. So as the short term downward trend approaches the level or zone of the medium trend provided by the upward trend line, two things usually happen. So number one, the short trend continues to move down in a violation or total disregard to the medium term trend and the trend line, which should have acted as support, meaning the medium term trend line intersected and now becomes invalid. In this case, it may be the start of a new downward medium term trend, because remember, it was on an upward and then now it should be going downward. So the second thing that can happen is basically the fact that the short term trend bounces up from the medium term trend line and obeys it. So you sell on a 15-minute trend line entry and the market is going down nicely, and soon as you come to an opposing medium term trend line, the medium term trend line has more significance than the short term trend line. Therefore, the market has a very high probability of obeying the medium term trend line, even though right now the market is going down on the 15-minute time frame. So remember, what is happening on our bigger time frame is what basically the smaller time frames are following, right? It is also key to notice that when a trend line on a short time frame penetrates through the trend line on a longer time frame, that usually signifies a turning around point or the beginning of the opposite movement on that higher time frame, right? So as you can see here, what is happening, we have our short term trend line. You have your selling opportunities when it comes through, but then here we have our long term trend line on a higher time frame. So this is drawn on a higher time frame. So if this is 15 minutes, here we have at least our 1 hour time frame, right, showing us what is happening on the overall trend, or at least the 30 minutes, right? And then here, look what happens. So the price breaks through and it becomes our support. So this now becomes our resistance. This is a resistance at the moment, but then the moment it broke through here, it's now become a support. So when it becomes a support, that means it's just following the trend line that is happening. So what I want you to notice is that for example, let's say this is our chart, right? Let's say this is our channel. It's a channel that is happening right now. This is a channel. I want you to understand that there is inside the channel, there can be something like this, right? There can be something like this, something like this. Can you see what I'm saying here? We call it trends inside trends. Okay, trends inside trends. So let's say this is a 1 hour chart. This is a 1 hour chart, the overall, but inside it we have movements on a 15-minute chart. All right, on a 15-minute chart. So this is our 15-minute chart, and in the 15-minute chart, the market is going up, down, up, down, up, down, up, down. But then the overall direction, we're saying that the market is going down on a 1 hour chart. But the 15-minute chart, you are able to capture this buy trade and exit your points over there. You are able to capture this sell trade and exit your point over there, and enter another buy trade, exit your point there. You see what we call trends inside trends. So that's basically why you are able to capture this this short-term trend line inside of another bigger time frame. So it just means it's a trend inside another trend. You are able to capture that trend on a smaller time frame, but overall the whole trend will be respected at the same time, right? So the market will continue doing something like this because it has to move forward, but at the same time the market has to move up or down. So now how this is possible is that for example, let's say on a 1 minute chart, compared to a 5 minute chart, right? So to compare to a 5 minute chart, here we can have 5 candlesticks forming a certain pattern, right? But here that one candlestick one candlestick on a 5 minute represents this pattern here that has happened here. So during these patterns, this 5 candlesticks that are formed on one pattern, this can be just one candlestick, right? So that candlestick during this pattern, when it goes up and down, up and down, up and down 5 times, that means this on the 5 minute chart is just one candlestick that has gone that has reached the lowest point. It has reached from the opening side, it has reached the opening the lowest point. It has gone all the way to reach the highest point. At the same time, it came back to play around here and then went back to its closing position. So I hope you understand what I'm trying to say here. But basically, that is why this is very much possible to have a trend inside another trend, right? That is why it is possible, because the market is moving up and down, but as it moves up and down, here it's making it on a smaller time frame is making full candlestick patterns, but here it's just being represented by one, depending. So if it's a 5 minute, that means five candlesticks on 1 minute are forming that one candlestick, and in that 1 minute time frame, maybe this is from 10:15 to 10:20, just 5 minutes later, this market has moved up and down, up and down. This one has just moved up and down as well, exactly what this thing does, but it's being represented by just one candlestick on this time frame, right? So it's kind of confusing, but if you take a look at it and just to try to break it down and see exactly what is happening, you understand that it's very, very easy to understand. And that is basically why you are able to capture these trends inside trends. So that is very key to understand when it comes to short-term trend lines and long-term trend lines. So we are able to capture some short-term trades, but the overall trend line will be respected in most cases. That is what I want you to get hold of in this section right now. So if you come across a situation like what we have here on top, you should be prepared to know what to do next. So if you're in profit based on the trade taking on a short-term trend line and you are in this situation, you may decide to take profit or take some partial profits and let the remaining lots run at break even, meaning that you have moved your stop loss to break even and you have taken it out. Remember, we explained that when you have a 10 lot size, you can remove 5 of those lot size and have 5 remaining in the trend. So this is what we're saying here, and then you move your stop loss to break even of that trade, so that if the market turns around and hit your stop loss, you don't lose anything, right? Not even the spread, right? You can move it to break even where even the spread is covered, or you can move the stop loss to your entry point and then you just have to leave the spread, right? So you only pay the spread. So if the market moves against you, it won't affect you because you profit from the previous close position. So let's say you actually enter a trade, right here, and then you are seeing that the market can turn around and you're somewhere around here. Then you move your stop loss somewhere around here. So that means all this is your profit that you have taken, right? That you have protected. If the market comes here, you hit your stop loss, you take your profit that is there, right? So you know exactly how much you make if the market turns around. It is also important to understand this and have a bigger picture of the long-term and medium-term trend and trend lines when you're entering trades in the shorter term trend lines, right? So you don't want to be wondering why the market has turned against you in the particular move, because you have the overall direction of the trend of the market, so you won't be surprised when the market all of a sudden comes and it hits your stop loss, right? Trades taken based on long-term trend lines and medium-term trend lines have a higher probability of success, which means big profits when the market moves in your favor. This also comes to understanding how much money you have in your account, right? So if you have trading with very, very little capital, you obviously want to capture those small trends because you might not be able to hold a retest in a bigger time frame before your account actually blows. So this is where risk management and lot sizes are very key to understand what is happening and your leverage to know what is really happening. So trading in much smaller time frames using setups happening in the smaller time frames sometimes can be very stressful. You will spend a lot of time watching every price movement and you will not have a bigger picture of what is happening in the larger time frames when trends form. So this is very, 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 very risky. They will override the little trends that may be happening in the smaller time frames. I don't say that trading smaller time frames can be profitable. It can be when the setups on H1 or H4 takes time to occur, you can switch to the 1 minute and the 5 minute to see if there are any trend line setups that you can take trades. And then your aim should be to collect at least, you know, between 10 to 20 pips for all those trades on your smaller time frame. So if you want to trade in smaller time frames, then it is good to use the 15-minute or the 5-minute as your larger time frame to draw trend lines in the smaller ones, which will be, so if you're on a 15-minute, you're drawing trend lines on a 5-minute. If you're on a 5-minute, you're drawing your trend lines on the 1-minute time frame. But a very key point when you choose to do this is to focus on currency pair that have lower spreads, like the Euro USD and the GBP USD. So I prefer big time frames like the H1 and the H4. I keep my trades running for days or even weeks if there is a good move and I can keep riding it. So the best way is to switch to smaller time frames to trade setups that happen in bigger time frames. It allows you to make few trades but high probability trades that have potential to bring massive profits. These trades are based on trend lines drawn from larger time frames. So remember, we said you can use smaller time frames for entry points. This is what we mean when we say trade with a trend. Trade the setups that you've seen on the 4-hour and the daily chart, but entering a position on the 15-minute chart. So if the H1 and H4 is saying uptrend, and then you come down to your 15-minute, you see an uptrend beginning, then that's basically a very powerful trade which will allow you to enter in that trade at a much earlier position than what you would when you wait to see a full confirmation on the H1, right? But you obviously know that the whole overall direction on H1 and H4 is in agreement, right? It's in agreement, and you're just waiting for a perfect entry position. So the best way to analyze the charts is using the multi-timeframe analysis, starting from the monthly charts down to the hourly. So the top-down analysis, very, very key when it comes to analyzing charts. So start off with the monthly chart and see if you can find obvious peaks and troughs to draw your trend lines there. And if there's no peaks or troughs to draw trend lines, switch to the next time frame, the weekly chart. Obviously, when you're coming from the monthly, the next one is the weekly on MT5 or MT4. So the process is repeated from the weekly down to the hourly chart until you get to the time frame that you want to trade at that moment, right? So for clarity, you can use a different color for each trend line that you analyze. So on a 4-hour chart, you have a different color compared to the next time frame that you drawing your trend lines on, so that you can see the difference, right? So you can spot out the difference and everything. So here is an example of the Euro USD. So beginning with the monthly time frame, I can see that I can draw 2 trend lines, so one up and one down. So we're going to use the color blue for these trend lines. So the first one, as you can see, this is the first one right here. So it's going down. That's our first trend line, and it's on a monthly chart. And we have our uptrend all the way up here. As you can see, it's no obstruction in the way, confirmed trend line right there. So our key points to notice here, we have key point number 1 here is the fact that price obeys resistance trend line. So this resistance trend line has been respected right there. As you can see, it has been obeyed. And then the second point is that to notice that the price broke through support trend line here over here, and then it's been respected. So what does that mean for us? It shows that the market is continuing down, right? It's going to continue going down. It broke here, respected it over there, the market should carry on going down. So that is our takeaway from the monthly time frame here, so that when we go to the smaller time frame, we are looking for positions that will help us to enter sell trades going down. So right away from this chart above, one thing that is immediate that gets my attention is I noticed the price is moving down on the monthly. So now I'm moving on to the weekly chart. I draw more trend lines using the red lines right here. As you can see, this is our now on our weekly time frame. So I can clearly see that the price is now approaching the red trend line and is about to make a break. So right here is about to make a break. New candle open below the trend line, meaning that is about to break this market going to the downside and turning this trend line here, which was supporting the market, into a resistance trend line. So it basically should be a retest, and then from there it should continue going down, right? I know that maybe in the coming few days price will move down, and I'll be waiting on the H1 or smaller time frames for entries. So I only analyze the monthly and weekly, and already I know what to look for on the smaller time frames. So you can analyze from the monthly up until to the 15 minutes time frame, so that you can get more confirmations.